Welcome to TradeTheMBA.com. This is John. This report is for the 24th of March. Well, yeah. So things were looking ugly. Trump talked about, that he's been in contact with Iran and the excitement started. This bar with the giant wick in that doesn't really reflect all that took place, but of course the Iranians denied it, blah, 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 blah. But it was enough to save the market and potentially give hope that things might end. Now, that said, you're looking at a reality that is undeniable. Now you've gone a couple of weeks with no transit of oil through the Strait of Hormuz. You're going to be looking at serious deficits on a daily basis for oil. And that isn't going to get corrected. And now you see bombings and explosions in the U.S. The facility, coincidence? Possibly, but really? So is that terrorism? And these kind of disruptions aren't going to be resolved shortly, particularly even the bombing of infrastructure in Iran and that, because it takes a long time to fix these things. Same with Qatar, UAE, Saudi Arabia. These things don't get fixed overnight. So, yeah, there are problems that are brewing, and is the market counting them? At this level, not so much. Uh, that's just the reality of it. But yeah, there's going to be some not just sticker shock, but it's going to be persistent, and that's going to get ugly over time. So you have to weigh that one to what you're thinking about. Is this one to trade the daily chart? And we look at the daily chart. This is very promising here. You've got the orange dip below red. You've got the green crossover. These are all things you're looking for from a buy configuration. You're above the 23%. That's all roses, you know, jump and run. But today's market, you're looking at a 50K that does this kind of ATR move within the single bar trading in that. It's a little extreme now. Where I was at in the 5K area, not so bad because as I was watching it live, and this was the interesting thing because I was comparing this with just the regular Deocon paint, and the difference being is the higher red pivots that take place in there, and that's why the regular paint a little one bar earlier in the entry. But needless to say, still capturing the concept of what we're looking for. The rest of the day, I mean, you got to understand from that buy configuration there, 6511, that takes you all the way to the open right there at 67. I mean, whew, that's 200 quick points right there, that fast. Yeah, and each of these little moves still represent 40 or so plus points back and forth. You go from the open short right there, which was 88, until the reversal at 45, and you're doing that all day long. I mean, and then we had this extreme one that was longer short from, well, let's just call it 6,700 until the open down there at 6627. So these are big sizable moves, easily captured on a 5K chart with continuation. I mean, that's massive. I mean, this is more points in a single day than you get in weeks of regular trading. I mean, it's just that's how extreme the situation is. And then even at the end of the day, huge drawdown going through there. We had a brief fake pop. The interesting part about this is when we start to break down and look deep into it, what you get is a situation where you have your DOC crossover here where green is coming from below, above crosses, the red crosses as well, and you get the orange dip. The orange has got a dip below both, ideally, not just the green, though that's mildly bullish, and you can see a very short, brief run. So it's always the question of do you flip over for just that period, take the run up? It's only going to last 3 or 4 bars, which usually is just the amount of time it takes for orange to go from under green to over green. At that point, green had better cross cyan, and then when it doesn't, or if it flips back above, you go back the other direction. Um, we happen to know that this is going to be a short-lived move. So in this particular case, because you already have the advantage of being higher from an entry, there's no point. So it's just a matter of leaving it to go lower. Same thing happens at this lower spot, um, because we don't have a reset of the steel coming back underneath. And the second one, the approach right there, also fairly decent. So it's a trade-off between finding a median that satisfies both conditions, but doesn't get you jumping around excessively. And that's a negotiation. But what really I'm working with on it is the fact that within certain Morganacci ranges, the signaling very different, because you expect that you're going to get these minus 20 dips when you're in the under 38% Morganacci lines to the 0%, and likely to have higher moves when you're up. So when you get one that's down in the 23%, but you're at a much higher red DOC, it's a bit stronger from a strength standpoint because you've already improved quite a bit versus being extremely in the negative territory. And that's kind of reflected in the shakeout here, where you have that deep red and then it converts to the more positive, and then we get a much softer, even though you made lower lows, it's lower lows on higher shakeout readings, lower lows on higher DOC red, and it becomes a divergence. So all that gets factored into the program aspect of it. And you can see the effective push from that quite strong. But again, it goes back to the same thing. You really end your run, even with cyan under red, once that orange moves outside of the range between cyan and red, you get problems. So in this particular case, orange gets past the green. Literally, it's opportunity to set a stop or exit on the higher move from a practical standpoint, and then waiting for that crossover, or in this particular case, you just get stopped out of it with the higher level, and that becomes the effective one. So it'll be a little bit different from a trade aspect than just the straight paint bars, though. You literally could trade those paint bars, given what we're seeing here. No issue whatsoever. It's just about getting a little bit more precise within those, and that's where you'll see, I'll add the ABM on those, where you'll see the line come through, and that's where the other version here in the Diocon paint, if I pull that one up, captures a little bit more of those. It will be interesting because you can see where it takes those orange dips and it marks them every single time. Regardless of how deep that decay is. And in this particular case, when you get that kind of decay, we know it's very difficult for the pops to last, because once you're out of range with that orange moving above the green, your run is pretty much expired at that particular stage. And then it's just a question of how long does orange stay between cyan and red, or even cyan and green. Those usually create your little flips. In this particular case, you can see it was literally 2 bars and you were done. And it goes from there. We can talk then secondarily about cyan. Whenever it dips below 0, you end up with a bit more of a bullish move that's building. When you get to that -7 range, yeah, it's pretty strong from a cyan view. And of course, in this case, it dipped below red. So, that was why you moved all the way up to the 50%. So those things become rather obvious markers. It's just a question of, trend follow versus, active up and down. And of course, that being more active as you get into higher time frames. So when we look at a 50K, you would be more responsive to pre-moves in that kind of situation. So that's where there's just a subtle difference as you change time, as far as an aggregate. So a little bit of differences, but overall it still captures the broad essence of everything. So I just thought I'd give a little bit more detail on that. Then you couple it in with the MBI readings, and it becomes quite strong, because that magenta over yellow, but MBI white leading still tends to be that short cover rally within the buy. But as soon as that flips, it's pretty much the end of it. And what we begin to see is a relationship between the pivots of MBI white relative to spikes of the orange. And then we start to get an understanding of one may precede the other in that, but usually that's a significant portion where you end up with the top. This particular case, the MBI white pivot right about there, pretty much corresponding to then subsequent higher pivots from the DOC orange. And the fact that they're completely drawn from unique math, completely separate, when you get similar behavior, you have a confluence, and that's where we get the value from some of these setups. So detailed, a little more complicated with an indicator review on there, but still gives you an idea. There's still a beautiful time to be trading the market, but not with regular indicators. You'll be whipped around so bad I can't even imagine what some of these guys must be going through. But that's their issue, you know. If you don't have the right stuff, then yeah, you're going to get beat up. That's where they either just step out of the market or get into their buy and hold or try and move to much further out time frames so that they can accept the huge range of volatility, which I don't know that that's as effective, because when volatility rises like this, I think you need to get closer to the action so that you can mitigate exposure. And you can see here within the 5K, it's very easy to control exactly what's going on. Less so with the daily because those swings are pretty massive. Anyway, long-winded on that, but nonetheless, it's still significantly important when it comes to overall trade practices. Anyway, anything relevant, I will put it on our team chat. Have a good one. Trade well.